You're 60 with 1.5 million saved up, and you're wondering, when should I take Social Security? Today, I'm going to walk through the planning process of a client in the same situation as you, and my goal is that by the end of this video, you'll have all the knowledge you need to be able to make an informed decision on what the right option is for you. So let me introduce you to Mark. Mark is 60 years old, he's married, his wife is 58, and they're both looking to retire in the next couple of years. Now, they've done a lot of things right. They've paid off the mortgage on their home, they don't have any other debt, and they've built up about $1.5 million in investable assets spread across a 401k, an IRA, and a taxable brokerage account. Mark's wife has her own Social Security benefit, but it's substantially smaller. Mark's wife doesn't qualify on her own work credit, so she is allowed the spousal benefit. So because Mark's benefit is larger, that's the one we're going to focus on today. In terms of retirement spending, they would like $96,000 per year in after-tax income, about $8,000 a month. Now here are Mark's Social Security numbers in today's dollars. If he starts collecting at age 62, his benefit would be about $2,100 per month. If he waits until his full retirement age of 67, it jumps to $3,000 per month. And if he delays all the way to age 70, it's about $3,720 per month. So numbers-wise, that's a 43% increase from age 62 to age 70 for the rest of his life. Now we're going to run 3 versions of Mark's retirement plan, exactly the same in every way except for when he starts Social Security. So in scenario 1, he'll start at 62, taking it as early as possible. In scenario 2, he'll wait until 67, his full retirement age. And in scenario 3, he'll delay until 70 for his maximum benefit. In each scenario, we'll look at 4 things: year-by-year cash flow, where the money is coming from, portfolio balances over time, is their nest egg growing, shrinking, or holding steady, probability of success. We'll use a Monte Carlo simulation that'll show how likely the plan is to succeed in a wide range of market environments. And finally, total lifetime Social Security income, so we can see the cumulative effect. Again, the only thing changing between these 3 scenarios is when Mark starts his benefits. Everything else stays the same. Same retirement age, same spending, same investments. All right, let's start with scenario 1. Mark retires at age 62 and turns on Social Security right away. With inflation adjustments, that means he'll start receiving about $26,500 per year in 2027. The rest of the income he needs, about $73,400 per year, comes from his investment portfolio. In our 5-year cash flow chart, the net cash flow is the amount needed from the portfolio. In these early years, the withdrawals from his portfolio are smaller than they'd be if he wasn't taking Social Security yet. That can feel comforting to some retirees, knowing that you're not pulling as much from your savings right away. In terms of plan success, the software runs 1,000 different market simulations, some good, some bad, and in this scenario, 81% of those trials end with Mark still having money at age 90. And his total lifetime Social Security, if he lives to 90, is about $758,000 in today's dollars. Okay, so now let's move on to scenario 2. Mark is retiring at the same time, age 62, but he doesn't take Social Security yet. From 62 through 66, every dollar he spends comes from his portfolio. That means higher withdrawals in those early years. Look at that net cash flow number for each of these years. Instead of us pulling $73,000 in 2027, we're now pulling almost $100,000. But at 67, Social Security kicks in at $36,000 per year. And you can see in the withdrawals chart, the amount he's pulling from his portfolio drops substantially once those benefits start in 2032. His probability of success is 88%, 7 points higher than taking early. And his lifetime Social Security, if he lives to 90, is about $988,000. So in scenario 2, by pushing Social Security out to 67, we're not only collecting more in lifetime benefits, but we're also increasing Mark's probability of a successful retirement. Now let's look at scenario 3, where Mark waits all the way until 70. From 62 through 69, he's living entirely off his portfolio. Those withdrawals are the highest in any scenario. Look at year 2034 in this scenario. he's pulling nearly $150,000 out that year. But at age 70, Social Security kicks in and he's getting $44,640 per year. At that point, his portfolio withdrawals drop off substantially. His probability of success in this scenario is 92%, the highest of the three. And his lifetime Social Security, if he lives to 90, comes out to about $1,040,000. Okay, so we've run through these three scenarios, and it looks like we have a clear winner. But there's a piece to this Social Security equation we haven't talked about yet, the break-even age. This is the age where the total dollars you've received from delaying Social Security finally catch up to and pass the total you would have gotten if you started earlier. Now, this would all be a lot simpler if we knew exactly how long we were going to live, right? But since we don't, here's how we need to look at it. The break-even point for starting Social Security at 62 versus 67 is roughly age 76. So if you live past 76, you're better off waiting until 67 to start collecting Social Security. The break-even point for 62 versus 70 is about age 78. So if you live past 78, you're better off delaying until 70 to start Social Security. So, if Mark lives well into his 80s or 90s, which is what we were calculating for in these scenarios, delaying will pay off in total lifetime benefits. But if he passes away before those ages, starting early would have paid more. This is why life expectancy, your health, your family history, matters so much in this decision. But I want to take it one step further because break-even age should not be the only factor you're considering here. There's two more big things I notice a lot of retirees aren't considering when it comes to collecting benefits. First is taxes. They can change the math in a big way. So in scenario one, Mark started Social Security at 62 while also taking withdrawals from his retirement accounts at the same time. That overlap pushes more of his Social Security into the taxable category, because up to 85% of your Social Security benefits can be taxable depending on your other income. In scenario 3, when Mark waits until 70 to collect, from 62 to 69, he's living on withdrawals from his portfolio alone, and those withdrawals can be strategically managed. This is a golden window to do Roth conversions, moving money from his tax-deferred accounts into tax-free Roth accounts, while keeping his overall tax rate relatively low. Now, why does this matter so much? Well, once you turn your Social Security on, it becomes much more challenging to do those conversions without bumping yourself into a higher bracket. So delaying benefits doesn't just give you a bigger check, it can give you quite a few years of tax planning opportunities. The second factor is something most people don't think about until it's too late, and that's survivor benefits. If Mark passes away first, his wife will step into his benefit. That means the size of his Social Security check becomes the size of her check for the rest of her life. Now, if Mark takes benefits at 62, that survivor benefit will be smaller forever. If he delays until 70, that survivor benefit is as high as it can possibly be. For couples, especially when one benefit is much larger than the other, like in this situation, delaying can be one of the best forms of financial protection for the surviving spouse. In Mark's case, the potential of his wife living another 20 or 30 years after him makes that higher survivor benefit a very strong argument for waiting. Okay, so we've run through our scenarios, talked about some important factors, but now let's mess with some of the variables. First, what happens if the market drops right as Mark retires? In scenario 1, taking Social Security at 62, he doesn't have to withdraw quite as much from his portfolio in those down years, which can safeguard his balances a bit. In scenario 3, waiting until 70, he's relying entirely on his portfolio in those first years. If those years happen to be bad ones in the market, it can create something we call sequence of return risk, where poor early returns have a lasting negative impact on the portfolio, sometimes meaning the portfolio will never be able to recover fully from that early drop. Now in this case, Mark has strong enough reserves that he could cover those early years without selling stocks in a downturn. That allows him to still delay Social Security without damaging his long-term plan. But if his portfolio was weaker in terms of asset allocation and/or total value, this may be a different story. Let's say instead of $1.5 million, he had $1 million saved. With that amount, our simulations may suggest that a few poor years early on could tank their retirement. This is something a financial advisor can run for you. So reach out to us and we'd be happy to schedule a complimentary review for you. The final variable I want to adjust is life expectancy. Let's say Mark is in a different situation health-wise. He smokes and both his parents passed away in their 70s. In this case, the probability of living to 90 is much lower. When we run the break-even math in our planning software, the tipping point for waiting is so far out that taking at 62 makes more sense financially. This is why there's no one-size-fits-all answer. The same strategy that's perfect for Mark from a number sense might be completely wrong in a health sense. So what did Mark ultimately decide to do? After looking at all the data, cash flows, portfolio health, taxes, survivor benefits, Mark decided he's going to wait until at least 67 and maybe 70 if markets cooperate and his health stays good. The reasons why are higher lifetime benefits, stronger survivor benefits for his wife, more tax planning flexibility in his 60s, and higher probability of success in his retirement plan. And that's the big takeaway I want to leave you with today. Don't guess. Don't just follow a blanket rule like always take it early or always wait until 70. Run the numbers for your life, your savings, your health, your tax picture, preferably in a planning software like eMoney where you can see the whole plan, not just one piece of it. There's a couple of ways you can get this process started for yourself. You can reach out to us by email or phone to schedule a complimentary review, or you can receive a complimentary video review from us by clicking the link in the description or scanning the QR code on screen. After you fill out a brief form about your personal financial situation, we'll review your information and send you a video. Thanks for watching, and we'll see you in the next one.